Jayant Acharya, Joint MD and CEO at JSW Steel with us, joining in to talk about the numbers. Thank you so much for taking time out. It has been a beat in Q1 versus what the street was penciling in, but still, sequentially, there has been a dip due to the lower volumes and the higher iron ore cost. What exactly is the outlook in terms of all of these individual dynamics on where your earnings are headed?
The global economic situation, as all of us know, have challenges, but it has been resilient. I think World Bank has improved the forecast by 40 basis points, and we see some small recoveries in some parts of the world. Having said that, I think the supportive factors are a declining inflation, a lower commodity price, and energy prices. India, the strong economic momentum continues, and we see it's driven by both the business and the consumer sentiments. The services and manufacturing both are doing well. The growth continues to be supported by a very strong capex from the government in infrastructure. The manufacturing activity is good. It is further supported by a supply chain realignment, which is happening globally, and India is benefiting out of that. We see a stable currency and FDI inflows and FII inflows, which is coming into India based on a strong, India outlook. The global steel industry, by and large, has moderated production between Jan to May by 1.2%, but China production went up, and the rest of the world came down. China, unfortunately, the demand did not play out as we thought post the freeing up or opening up of the economy post-COVID. The demand, therefore, was not supportive of the production, and exports increased. However, China has declared that they would like to cap the steel production to last year's level, which means that in the H2, the production would get moderated, and that would be positive for the global steel industry at large. Indian steel consumption in this quarter grew by 10%, which is one of the good numbers, good performance in a quarter one. And we see 8 to 9% growth for the year, which would incrementally add 10 to 11 million tons. We expect India to consume about 130 million tons ballpark in the year.
Right. So fair to say that you are on track for the 25 MT sale guidance?
With your question on the guidance, on production for quarter one, I think our numbers reflect we are on 100% of the guidance. On sales, we are at about 93, 94%, and we are confident that we'll be able to achieve the guidance this year. We have added some inventory in this quarter, primarily due to the cyclonic impact in the second half of June. Many of our materials which were in transit to the port and loading were impacted, and some part of the sales in the western part of affected cyclone area got impacted. But we are quite hopeful that we'll be able to liquidate the inventories in the coming months.
That there is a benefit of lower coking coal which will come in second half. What will happen to that? How will that help your EBITDA per ton expand?
So it would be difficult to give an EBITDA per ton number, but I would like to hazard a guess saying that the coking coal prices and softer, maybe slightly softer iron ore prices, which we expect, will offset the fall in prices which have already happened. The steel prices, as I said, have bottomed out, and therefore the margins we will be able to either maintain or it will remain range bound.
Okay, your net debt as well has risen this quarter to about 66,800 crores, largely due to the higher working capital requirements. Could the rise debt continue from here on, or is there a plan to keep it around this range?
Yeah, so the debt in this quarter has gone up because of two main reasons. One, we have added inventory of about 300,000 tons odd, which has resulted into some working capital going up. We have also paid off some of our higher coking coal priced, which was due in this quarter. and that has again added to the working capital cost. So therefore, the working capital during the quarter has gone up. We expect that we will be able to liquidate the inventory in the coming quarters, and some of this would therefore come off, and you will probably see a slightly better number than what you're seeing today. Having said that, that would happen, the better number should happen in spite of the fact that we will merge JSW Ispat. We have got the clearance from the necessary approvals have been obtained, so we would merge it in Q2, and that would add some debt. But in spite of that, we are confident that we'll be able to get it down below what it stands in Q1 today.
Right. So since we're talking about balance sheet, we understand that there is NMDC Steel as well, which is on the block. Vedanta might look at selling steel business too. Would you be interested?
So NMDC, we had filed our expression of interest, and we were shortlisted as one of the parties for that. The data rooms are open now, and we are analyzing the data which have come in, and we would look at the data and then take a view. As far as Vedanta is concerned, I think that is a news of late which has come into the market. We are also analyzing that, and we will take a view. I think we understand it has the steel as well as the mining assets. The mining assets hold more interest for us, but we are evaluating the situation, and then we will take a call.
Right. So you are interested in not ruling out acquisitions, and separately, JSW Steel is also set to mull a bid for buying about 20% stake in Tech Coal unit, close to $2 billion. Can you clarify the details? Is that true?
So our priority, as we have mentioned earlier, will be raw material security as we are expanding our capacities in India. And therefore, we will focus on iron ore backward integration and coal backward integration to the extent possible. Metallurgical coal, when I say coal. So therefore, in India, we have acquired new mines in the iron ore auction. 6 mines have been recently acquired, and we would make efforts to operationalize 4 of them as quickly as possible. 2 coking coal mines which have come to us would also get operationalized in the next 2 years and would give us about 1 million tons of coking coal. In addition to that, we are looking to supplement our coking coal requirements by some hard coking coal assets internationally, and we are looking at assets strategically in different countries, including Australia and Canada. We have looked at the tech asset, but however, it is a feasibility study which we are doing. Among tech, we are doing others as well. And I think it's difficult to comment at this point of time on any valuation or interest. I think it is still early days.
Right. So are you looking at NMDC, Vedanta as well? You think the balance sheet has the wherewithal to take all of this in?
I think the way I would look at it is, as I said, our will be, as far as Vedanta would be on the mining assets. They have a iron ore mine in Karnataka and in Goa. We would be interested in certain assets in that sector. However, we'll have to look at the details. We still don't have it, so I will not be able to comment further on that. On the coking coal, as I said, we will take a call. We need to do backward integration, and we are confident that we will be able to get financing required to do some kind of a strategic investment in any of the hard coking coal assets which we look at, but it will be commensurately small compared to our total requirements. So we do not see a problem with the balance sheet to be able to take that.
Appreciate your time. Thank you for walking us through all those details, acquisition plans as well. So as of now, you're analyzing the Vedanta Steel assets, and that's the latest when it comes to the merger of JSW Ispat, and talking about how they have maintained their sales guidance. That's JSW Steel at about 780. But time to shift gears then. Let's